Good morning to Sandip Sabharwal, and let's understand what he makes of the current market. So, Sandeep, the party continues. Point is how long the party will continue. I mean, the Cinderellas of the world are now saying that 12 o'clock is nearing.
Well, yeah, so I think we are at 12 noon. 12 midnight is a long way off.
Noon, midnight is still a long way off. What gives you the confidence?
The carriage is not turning into pumpkin yet.
Exactly.
Yeah.
So I think there are several drivers which
तो
include
पार्टी चालू भी
a
नहीं हुआ
sort
था.
of
Party was this was according to Cinderella. This was an evening party. 12 noon तो party भी नहीं चालू हुई थी संदीप.
pre-party.
Okay.
Then there'll be party, then there'll be post-party.
Okay. So let's understand that pre-party and why do you think that market strength will continue?
There are several drivers which include, I think the critical part is peaking inflation and peaking interest rates. I think that's always positive for equities. Secondly, we are in a sort of Goldilocks as far as India goes, where growth is sustaining at particular levels, while inflation in India has peaked out much before global inflation. And that will help us sustain and incrementally increase growth going forward. Right now, whatever growth we are seeing is despite very slow consumer demand. As inflation remains stable or comes down, I think we'll start seeing consumer demand also revival, which some companies have started indicating that that's happening. And that was also like two-wheeler sale data, which has come out recently, also indicates that. A lot of people talk of valuations, how valuations are above historical valuation. That's fine. Like historical Nifty valuation, maybe 18, 19. Now we might be at 19, 20. It doesn't matter 1 point here or there. Typically, in a accelerating growth, improving economic environment scenario, price earnings ratios will expand and they'll go more towards sort of what we call bubble territories of possibly 30 times also where most of the past bubbles have peaked. And so to that extent, we are not nowhere close to that. And globally, cash positions are very high as people have been scared of investing in equities. And some part of that we saw in May with the kind of flows we've seen into India. I believe flows globally will accelerate into equities. So there are a lot of very difficult to concisely explain many of the reasons, but I think there are several drivers which are good for overall emerging markets and especially India.
Right. Sandeep, just wanted to understand what is it that you made of Infosys's annual report takeaways? I mean, the fact that they're laying that much emphasis on AI seems like they're moving with the times clearly. Of course, the salary cuts aside.
Yeah, so I think all these companies have to talk of AI, and because AI is a reality none of us can escape from, and to that extent, how companies adapt to that. In so there are some companies which will not be impacted so much. There'll be some companies like it is widely believed, and although technically very tough to evaluate the impact, but that the IT services industry will be impacted the most negatively due to a lot of these automated code generation systems, etc., which artificial intelligence pulls out. So they might be talking of it, but it's a big challenge for their business and how they cope up with it to can they use it to accelerate growth or we are in a phase of prolonged deceleration? That is something we'll need to see.
On then, time to shift gears and focus in on stocks on the editor's radar. Today we're discussing the metal space as well as AU small finance. Let's begin by talking about metals because clearly we have seen that underperformance take place within the space. There's a lot of factors, Nikunj, that have attributed to it, but can we see a turn in the tide?
Not for all metal stocks, Avan. I'll tell you why. Because so far the beginning of the year, the positioning was that China will open up, metal demands will come back. I guess now the realization has kicked in that look, everything in which is solely connected to the Chinese demand may not do equally well. I think metal stocks in my book as a category may not be the outperformers in 2023. However, selectively, there are some steel stocks which you may want to look at, and largely because coal prices have come down, and incrementally that's a big positive for some of the metal companies. Look at domestic companies and look at companies which essentially are supplying to the domestic market, because a weak dollar means they would have an advantage, and the advantage largely lies to the fact that in India, metal prices are global denominated. So currency is on your side and international coal prices have come down. So it's going to be a double advantage for some of the steel companies. And the steel cycle also globally is not reversed, unlike what we've seen, let's say, in something like copper. So a lot of the metal stocks globally, I guess, have a readjustment which should happen largely because of the Chinese demand not opening up.
All right, so that's the readjustment that we're expecting, but it won't be across the board when it comes to metals. Let's move aside then and talk about another mover, and that is AU Small Finance Bank. Now, it's interesting because in the last 15 days, we've seen 2 downgrades come in. Citi is the latest one. They've got a target price at 725. They've downgraded the stock to neutral. And you've had Chris Wood as well flagging off this very same stock in his portfolio.
Look, this stock has done exceptionally well, and there was an overhang that what will happen to Sanjay's reappointment, and Sanjay Agrawal got reappointed for 3 years. The result reaction or the stock reaction was immediate. It went up 20% the very next day. It's up 30% after that RBI ka hara jhandi, that reappointment approval by Reserve Bank of India. Now, AU Bank, I think, is a brilliant franchise, but a brilliant franchise which after the run-up is actually available at fair to expensive price at the current juncture. The construct for AU is that it will continue to grow in the range of about 20% plus because the base is low, and ROA would be anywhere between 1.8 to about 1.7 or 1.9. That's the guidance from the management. When you're buying a stock which is giving you that kind of a combination of 20% growth with a ROA of about 1.8 to 2% and ROE of about 15 to 16%, 3-time price to book is what markets historically have given such a franchise. Right now it's 3 plus. So it's the recent run-up which in a sense is just making the stock look slightly bulky. So the stock will have to lose some fat. It has to go on the treadmill, muscle up, maybe a time-wise correction, or maybe 2 quarters of earnings.
Okay, there you have it. So that's AU Small Finance, Aisha, as well as the metals basket.
Okay, let's get you some more stocks, and here's some stock ideas coming in from Dipan Mehta, and why is he lacking those stocks, as well as Sanjeev Bhasin.
See, I think that there have been many challenges for Eicher Motors. Not now, I think last 3 to 5 years since we have seen the success of Royal Enfield. Many competitors have come, but they have not been able to make a significant dent. I think Eicher is miles ahead when it comes to competition in terms of launching new products. And what they are selling is a complete lifestyle, and they appeal to a certain class of consumers who are adventurous in nature. And that kind of a brand and that kind of aspiration can never be done by Hero MotoCorp or Bajaj. It's like any tier 2, tier 3 OEM trying to sell a luxury car. That just doesn't work. So I'm not that perturbed about any challenge coming from Hero MotoCorp or even Bajaj Triumph tie-up. The real threat for Eicher is going to be from the electric vehicles, because their main crowd also, the main consumers also are quite eco-friendly. And they care about the environment. So unless Eicher has a significant offering in the electric vehicle side, maybe 2-3 years down the line, that's when they'll start to face all the problems. But for the time being, I'm not too perturbed. I think that with the way they have expanded the distribution and the export opportunity available for Eicher, they should be able to sustain mid-teens type of growth for at least 3 to 5 years or so.
Electronics is a very sweet spot. Even electric appliances, look at Havells, look at Voltas. I mean, I can just give you the ancillary industries which are doing extremely well, and where these are going to be part and parcel for the next few years. Railway stocks were always few weeks before the rail budgets, and then they tended to die down. But look at the performance of RVNL or an Ircon or a Titagar wagon. It's telling you that the capex and the intensity with which the government is focusing on rail and in-road transport is humongous. That's why these companies' margins and they're maybe the best ever in history. And I think they've run up a lot, so they've doubled, tripled in the last 2 years. They can be caution and because they're overowned. Titagar and RVNL have been huge doublers from recent times.
Sandeep, what is the importance of this week's credit policy from a market standpoint? Because the bank nifty is already at a new high. Everybody knows that Shaktikanta Das is not going to increase rates. If at all, he will sound really constructive about the path ahead.
Yes, I think monetary policy becomes irrelevant now for a long time till we till we get to the actual rate cut cycle at some stage. Now, when that will happen, we don't know, because the possibility of a prolonged pause is higher given the fact that growth is sustaining at particular levels in India and could possibly accelerate. So, in this scenario, for a central bank to be actually cutting rates becomes difficult unless and until inflation goes much below 4%, which is not the base case. So, I think for a few meetings, in my view, monetary policy will become irrelevant in India.
AGX Nifty is indicating that we are in for a good start. Kunal, what's the all-time high?
18,888.
18,888. Okay, now where are we? 18,728, which means...
That's the SGX.
Yeah, I mean,
Futures.
SGX is indicating that we could be in for 100-point gap start. You need 200 points approximately to make a new high. So it may happen today, it may happen this week, it may not happen for next 10 days, who knows. But you're just almost at a new high. Mid-cap index at an all-time high. Bank Nifty at an all-time high. And if that was not enough, look at global markets also. They're absolutely roaring in terms of what the construct of the market is. So Sandeep, what's the new theme you're betting on? Couple of years ago it was defense, then from defense it moved to railways. Railways has become manufacturing. Anything you were looking at in terms of a theme?
No real theme per se, so I think we need to keep a lookout on whether we can get into some companies which actually benefit for artificial intelligence, etc., which doesn't seem to be there in a listed space in India. Then from the old set of stocks, I think there is a clear indication that companies are saying consumption is bottoming out and could recover. And consumption stocks have been relatively subdued. So I think that's where some opportunity could come up in some of the retail stocks or the pure FMCG companies.
Okay. Naresh, I'm looking at a list of some stocks which have gone down. I mean, stocks which have gone down on strong volumes. Angel One is one, Naresh. I mean, we've talked about this stock extensively in 2021, 2022, and it's nowhere close to its 52-week high. Is the best of the gain for something like Angel One, Motilal Oswal? Have they reversed?
So I think Angel One has relatively been better in terms of a price correction, but the rest of the older broking names have just collapsed. So Motilal Oswal has been terrible if you go back from pre-COVID till now. Even from COVID lows, it's not done much. ICICI Securities has seen a lot of say consolidation, but from a top of almost 850, 900, the stock is at 500. So if you look at all the broking names, Angel One has been relatively better because over the last say from 2021 it has gone up. Say 2021 used to be 400 rupees, today it is 1300 rupees, though on the upside it was 1900. So for now the problem is Angel One could be doing better than the rest of the names, but the sector is in a doldrum, or say a major top is already in place. So that's the only reason don't like Angel One, because the sector is not interesting at all.
Sandeep, we are in the middle of a bull run. We are in the middle of what could be called as a strong financial inclusion. We are in the middle of what could be called as a multi-year theme. But AMC stocks, brokerage stocks, all of them are at multi-month lows.
Yeah, brokerage is, so both of them are suffering from sort of profitability squeeze. So margins are coming down despite the business growing, and the squeeze in margins is such that the growth cannot compensate for it. So I think that's the challenge which brokerages as well as AMCs are facing. Most of the AMCs products have been typically underperformers, and that's also leading to investors moving out and looking at other avenues. So they are incrementally losing market share, although the SIP inflows continue to be strong. From the brokerage's perspective, like there's very little to distinguish from the other. Everyone is just going for the lowest brokerage, given the fact that with new SEBI regulations, your funds, etc., are relatively safe. So it's not that the brokerages can turn rogue and run away with your money. So to that extent, there's very little to distinguish from one broker to the other. So I don't like brokerage stocks because I don't think they have any real moat going for them. So that's where so I'm not looking to invest in these sectors at all.
All right, what do we have? May Class A truck orders, they're down 2%. Year on year, they may be up. Okay, year on year, they're down 2%. Month on month, they are up 9%. Sandeep, you've liked Bharat Forge in the past. Time to revisit that one?
I think so. I think it's reasonably priced. It had a run up above 900. Then there were some disappointing result prints as well as the news flow from the US related to Class 8 truck orders, which has incrementally a lesser play these days for Bharat Forge, but that's what somehow the analysts in the market seem to be tracking. So I think it's reasonably priced. It needs some trigger for it to perform, as in from some good quarterly result, etc. But strategically, what the company is doing in terms of diversification into various other spaces like defense or aerospace or other industries, I think that'll bear fruit going forward. I would think that it should be a decent play at the current prices.
As well as the other stock which is going to be in focus today. Their April-May updates have come out and their average monthly transacting users have gone up by 24% on a year-on-year basis, and the merchant payment volumes as well are up a staggering 35%, and again these are year-on-year numbers. The devices subscribed as well now stand at 7.5 million on total count, and the new subscriber additions, they stand at about 4 lakhs for the months of April and May. Sandeep, you think the worst for some of these, Paytm, PB fintechs, etc., is behind us?
Worst in terms of performance, yes, one could say that the kind of losses they were making, I think the losses will come down. But does that create an opportunity for investors to make a sustainable play? It's still doubtful because of their business models. For example, Paytm, if you see the entire improvement in profitability or whatever they are talking of is coming from their loan origination where they earn commissions on originating loans. That is not a high PE business because it's just like a commission agent working like a commission agent. So I don't know. I don't see these companies getting built in a manner where one can say that they will have some sort of a moat for years to come. So I would be skeptical buying into these companies.
Just want to check in on what's on the brokerage radar this morning. And remember, HEG and Graphite have been in the spotlight of late. Jefferies has maintained a buy on both of the counters, so they slashed the target price on both, saying that demand headwinds will persist. And beyond the near-term headwinds, decarbonization stays as well as a medium-term tailwind. They've cut the EBITDA as well for FY 25-26 by 88 to 16%, saying that there'll be a higher impact in FY 24. Just let's get in a view, Sandeep. I wonder if you track both of these counters and what the outlook is.
Sorry, which company were you talking about?
HEG and Graphite.
I think it's going to be a challenging time for them, especially given the fact that if you look at where the steel cycle is going, steel prices in China are back to 2022 lows after rallying more than 20% from there. That will put pressure on global, all the incremental sort of ancillary industries, and we could also see production cuts, etc., coming up. So I don't think there's any big story in these stocks at this stage.
Get in a view on the charts going as well. And Kunal, your outlook on HEG Graphite, given the kind of breakout that we witnessed?
So the momentum has come back into these names. Now, I think we'll have to look at this in the last 8 or 10 days of charts for HEG and Graphite. HEG specifically, the stock made a high of 1250, corrected towards 1125 in a matter of 3 or 4 days. And in the next subsequent 3-4 days, the stock went into a breakout mode and managed to break past about the 1250 mark. which means it's a classic V-shaped recovery for HEG, as well as the similar charts for graphite. Now, what has happened is in this last 3 days of price recovery, these stocks have given technically what we call it as golden crossover, where the 50 DMA has crossed back above the 200-day moving average. That is a classical sign of a possible turnaround for HEG and graphite. So, my sense is that these stocks could gain momentum even further from current levels.
Okay.
Right. Sandeep, the real go-to area right now is the entire urban luxury or the niche consumption space, whether it is watches, cars, a wine company like Sula. What looks interesting in that space? Because, typically how economies move is that the niche consumption, which is dominated by the affluent class, that in a growing economy always does well. And if India is headed towards what happened to US in terms of an economic, these categories and some of these specific categories are only going to explode.
Yeah, so I think niche consumption will do well. Unfortunately, most of it tends to be in global brands, and to that extent, what we are seeing is premium global brands on the consumption space are doing much better now in India than some of the medium to lower price products. So, but I think giving specific example at this stage is tough. So I think from the companies which recently listed, maybe uh, something like a Vedant Fashion could be a gainer in this, but there also the valuation at this stage seem to be a bit excessive. Sula, Vineyards, etc., although the wine consumption is growing, but if you look at the pace of their growth, etc., I think it's not so exciting that we give very high P's to that.
Okay, that's the view coming in. Let's move right on then and also check in on the pre-open rates that should just flash for you in about a couple of minutes from now. But in the meantime, Naresh, discuss the breakdown that we saw on the charts. Lemon Tree on Friday's trading session, and you also had something like a Gujarat Gas. What are the charts reading?
So, if you look at Lemon Tree, the previous high back in November was around that 100 mark. So that has acted as a resistance. The stock has taken a little bit of a hit. The stock topped out on the numbers, and now again the trend is still positive for the whole sector as such. I would expect 85, 88 to be a support going forward. So you want to buy closer to that. And the next time we go above 100, it should go higher. So Lemon Tree still looks interesting. Overall trend is positive. The stock back in 2018 also used to be 85 odd levels. So the stock has done nothing over the last few years. So still a promising stock. Want to buy the dips closer to 88. Gujarat Gas has been a disappointment. The stock was on buy list until we got stopped out finally. The breakout above 500, 495, 500 did not play out. We've seen the stock took a dip a day before this, and there was some follow-up selling on Friday as well. So technically, we get back into the same range of 450 to 500 now. So no, no trade here because the possibility of that breakout is again taken out. So for now, I'll avoid.
Fair enough. That's the view coming in on some of the stocks. That's our breakdown in trade. Sandeep, let's get in your quick thoughts then as to what you're advising when it comes to the entire cement basket.
Cement is an intriguing space at this stage because on one hand we are seeing that the cement companies are unable to pass on price hikes, so they try, but the prices come back because supply is so strong. On the other hand, we have got good demand trends and a complete collapse of sort of input cost pressures, and which will aid their profitability. And that's the reason why the stocks have also gone up so much. So it's a very tough sector to call, frankly. So there are tailwinds which at this stage look better than the fact that they are unable to increase prices. So I would say that people can buy these stocks, but I think at somewhat lower valuations.
Appreciate your time, Sandeep. Good to have you on board. Thanks so much for joining in. Okay, a quick look at the